Hello, this is Josh Belk with the Belk on Business podcast. Today we're going to talk a little bit about some year-end 2023 tax planning. This is going to be kind of a fast-moving, very much a bullet point type of a podcast, and this is primarily put together, most of our podcasts are, but this one specifically, really for going out to our clients. And for our clients that are listening in, this podcast will be accompanied by a scheduling link for a year-end tax planning meeting with my office. For everyone else, I hope you can just take a few minutes to listen in. Maybe you can pick up a point or two or three as I kind of roll through here. This is not at all going to be comprehensive. To try to go through and discuss everything would be exhaustive. Of course, it takes a lot of years of training and planning to be halfway decent at this, but as is true with most trades, But this one specifically, kind of very fluid as it relates to rules changing and things of that nature. But it's one hopefully that maybe you'll pick something up, maybe implement it to save you a few dollars in taxes, and well worth the few minutes that you take to listen to this podcast. So what I'm going to do here over the next few minutes is just kind of rattle through just kind of a list of maybe just some points to think about. Now, this isn't specific. Some of these are specific for 23. A lot of this is just very general. Some of these I've talked about in prior podcasts and are simply reminders. But either way, I hope that you do find this helpful. So first of all, kind of the big question that we get, especially from newer clients or just people that just have just kind of a general question of, okay, what can I deduct in my business? And the IRS generally says anything that's kind of reasonable and necessary, ordinary and necessary inside of your business, you can write off with, and of course, almost with all of these, there are exclusions, okay? But for the most part, anything that is reasonable and necessary that's not otherwise excluded. What I mean by that is, for example, meals, we're back to 50% deductibility in 2023 for meals, okay? So we know 50% of your meals are not going to be deductible, okay? There are certain things like overly expensive automobiles, for example, luxury automobiles may not be deductible. So we kind of go through, there are exclusions, but any sort of an expense that's ordinary and necessary, that's reasonable inside the business can be deducted. So if you kind of think about it, as you're kind of rolling through paying your expenses, you get to year end, if you are a cash basis taxpayer. And once again, this is kind of maybe a subject for another podcast, the difference between cash and accrual. But if you are a cash basis taxpayer, most small businesses are. And so if you're a small business taxpayer, if you go through and you prepay your 2024 expenses, that could be something that you may be able to do to reduce your 2023 tax liability. If you're accrual basis, you would not be able to do that. So as we kind of go through this, think about any expense that's ordinary and reasonable. Where I sit now, the office I'm recording at, this is in the office of my accounting firm. And so there are certain things that would not be ordinary and necessary inside the business of running an accounting firm. Okay, so if I go through and buy 3 cases of coffee beans, okay, just to use at home, okay, that's not necessary, not reasonable, it's not ordinary for this type of a business, okay. I could buy a box of coffee beans, okay, to be used inside of the business, and then we kind of get into the question of, well, how much of that is actually deductible. But just think about for your line of what the type of business that you have is your business. I also am a partial owner of other types of businesses, so I could go through and purchase, for example, I am a part owner of a daycare. So if I went through and bought boxes of food for the daycare, I could not expense it inside of my accounting firm because it is not an ordinary and necessary expense for my accounting firm. Okay, so anything that's reasonable and necessary, that's ordinary and necessary inside of your business, you, in all probability, can deduct it. Hiring of children. This is a question I get quite frequently. It's one that there's a lot of information put out there. People, and I want to caution you, don't be getting tax advice from people on TikTok or these other. So I'm not on these social media platforms, but there's a lot of it out there. I get forwarded these links. Some of it's good, at least it prompts you to think. But as far as implementation, make sure that you're bouncing any implementation off of with your taxpayer. I just got an email last night or real early this morning in regards to this exact topic from, I saw this video on TikTok. Is this true? And of course, there's always a little bit of truth to it, but the overreaching is no. If you did it the way that he or she suggested, then it would be a situation to where you're essentially doing it wrong and creating more tax complications for you and for your children. So hiring your minor children, so any child is 17 or under. First of all, you cannot pay them as a contractor, give them a 1099, and it be excluded as far as taxable income as it relates for the child and as a business expense to the business. The child is going to have to file a tax return. If you do pay them as a contractor, they, in all probability, be subject to self-employment tax, and essentially you did not solve a problem. Okay, so if you have a child of 17 or under and you have them paid as a W-2 employee, so a W-2 employee, not a 1099 contractor. Talked about this before in podcasts. There's no such thing as a 1099 employee. There's no such thing as a contracted employee. Okay, they're either an employee or they're a contractor. Contractors, you pay when you pay them, you issue them a 1099. You collect a W-9 on the front end. An employee, you receive a W-4 from them. You have them completed along with all the other forms, the I-9s, etc., and you treat them as an employee. So you are going to have payroll tax filings as the business. Now, it may just be a 9041 sent in if you're only paying your children. You send a 941. It just may have the child pay on there, and there may not be any other federal withholding. If you don't have any other employees, you may be subject to federal and state unemployment, and your child will be subject to state withholding as well, state and county withholding as well. So on the federal end, you can essentially you can write off to up to $13,850, which is a standard deduction amount in 2023, and not have to have federal withholding or pay FICA tax for them. Okay, so the essentially the Medicare and Social Security tax. So you won't have that piece of it. So if they're 17 or under, you pay them as a W-2 employee, you do all your payroll tax filings, and then lastly, they must actually be providing a service to the business. So some people, I'll just write them a payroll check for $13,850, and because they're my kid and they come in occasionally, maybe they help out with something. No, they need to be treated like any other employee. They're going to have an hourly rate. They're going to have particular functions they're going to do. So they must actually be doing work inside of the business. This is a strategy that I've used through the years with my children. They're no longer minor children, but when they were minor children, and it was a situation to where it did provide a tax benefit. However, they were providing a service for the business. Most years they did not reach that amount. Okay, most of the time it may have just been a few $1,000s, especially when they were younger, for maybe cleaning up around the office. My sons actually now, even still to this day, help me with podcast recording, a lot of data entry, things of that nature they do inside of the business. And so if they are a minor child, they are providing a function inside the business, you're treating them like any other employee, and then the other things that we talked about, then you can go ahead and pay them, once again, as a W-2 employee. Other strategies with this, at that point they have active income, you can contribute to an IRA for them, and so you can begin to build up for their retirement as well using those funds. Learn how to combine kind of the business portion and the personal portion. If you're going on a business trip, there's a kind of a majority of that business trip generally is 3/5 must be used for business. So if you go for a 5-day trip, for example, you may have a bookend of 1 day on each end that maybe you're doing a little bit more personal. Then the 3 days inside of on that trip is business, meaning 8 hours. It's documented. You're doing something. Then you could in all probability can write off the entirety of the trip. One area in audit scenarios where our clients many times get caught is they bring spouse and children with them that are not employees inside the business or not involved inside of the business work. Okay, beyond just them sitting next to you in a meeting. Okay, meaning they're actually involved on that particular business trip. Once again, it has to be documented. Otherwise, just your portion. So, if it's mom and dad and Joey and Johnny coming along on the trip, the spouse is not an employee. The children are not an employee. They're there at the beach while you're inside conducting business meetings or a seminar or whatever. You're only going to be able to write off essentially 1/4 of that trip. Okay, so make sure that you understand what those rules are as well. Next, properly classify business expansion expenses as for immediate tax deductibility purposes. And so kind of if you're going through some business expansion, have a conversation with your accountant as far as how to get this structured in a way that you can write off more of those front end costs. Next, properly identify deductible startup expenses, generally up to the first $5,000. You can expense anything over that. You are going to amortize. So make sure that if you are going through it in a business startup, you're going through in a situation, how do I structure this in a way I can write off more on the front end instead of amortizing all of those front end costs. Next, for 2023, some of those bonus depreciation rules that have been into effect. They went into effect with the Tax Cut and Jobs Act here back in the end of 2017. And we're beginning to start to see a phase down of the accelerated depreciation. So when I'm not going to get into a deep dive in different asset classes. So asset classes, anything 15 years and under. So that may be land improvements, that's 15 years, certain types of leasehold improvements. You get into any sort of personal property that may be 7 years, 5 years, equipment, things of that nature, vehicles. And then so those 15-year, 7-year, 5-year classes, they are no longer eligible for full 100% bonus depreciation in year one. It's only going to be 80%. Now, it may be a situation to where you're looking and using Section 179 to take the full 100% deduction for depreciation in year one. If it makes sense in your particular situation. But just understand that there is a decrease down in that bonus depreciation. If you're dealing with personal property type items, so equipment, things of that nature, you may want to consider using Section 179 to fully write that amount off. And most people never exhaust the limits, which are over $1 and $2 million in regard to the amount that you can write off in any given year. Usually not an issue for most of our clients. If you have a larger business, it may impact you. Okay, so I understand the depreciation rules have changed. The Augusta Rule, another area we get many questions on, where you can essentially rent your home to your business for up to 14 days and not and you can write off the expense as a rent expense and not have to pay income taxes on that amount personally. However, okay, I have yet to see a client do this right. Okay, even though we've gone through the education piece, it's just people just don't do it right. They just want to write themselves a check. Oh, they heard about it and they want to go back and write themselves a check for the 14 days, and then they come up with some arbitrary amount that they're wanting to pay. Okay, and it has to be done as if you were going and renting to a third party. Okay, so there actually does need to be a rental contract between essentially you and between you personally and the business. And then everything needs to be outlined in that contract. You do need to issue a 1099 miscellaneous for rents. From the business to you personally. Okay, now your tax advisor will be able to go through and structure this and hopefully and be able to show this and expense this in a way that it does flush everything out. Okay, so you must have a rental agreement. The payment must come from the business to you personally. Their 1099 must be issued, and you must have a comparable comps in regards to the rental amount. You can't say, okay, I have a 750 square foot house and I'm going to charge $1,000 a day in rentals, in a rental fee. Okay, that does not make any sense. Okay, find out what the amount is as far as kind of on a daily rent. You're going to have to do some work. Okay, you have to do some research. It can be a powerful tax deduction if you do use it. Make sure you are doing it correctly. Okay, next. Identify the vehicle deduction method that gives you the best deductions. A few years ago, they went into I'm sorry, skipping a point here. So the vehicle deduction, whether or not it's actual expenses or it's a situation to where the mileage is going to make sense. So if you are expensing the vehicle and depreciating the vehicle, you're generally going to use your actual expenses to the percentage of mileage that you've used. Otherwise, you could use a straight mileage rate. Most of the time, the straight mileage rate, which is 65.5 cents in 2023, generally provide the greater deduction for individuals and businesses. So kind of do that evaluation, which makes more sense: percentage of actual cost or your mileage amount. So correctly identify your maximum business mileage. Now, once again, this is another area most people don't do it correctly, and that's a contemporaneous mileage log. Okay, meaning that you need to have, and you can use MileIQ or something to this effect. There are other apps out there that can track your mileage. So find an app that tracks your mileage, or if you're using old school, writing it down. But what needs to be documented: where you were at, where you were going, and why you were going there. So the kind of the who, the what, and the when and the why. Okay, those questions kind of really need to be answered for each of those for each of those lines on that ledger. Okay, so where were you going? Who did you meet with? Why did you meet with them? And make sure that these are documented and documented thoroughly. In an audit scenario, the IRS will look at this, and if it is not contemporaneous, they will not allow for the mileage deduction. Don't go through and say, well, I drove about 12,223 miles last year. Okay, it doesn't work. Believe it or not, there's a lot of kind of just, you go through and you guess a number, and you can kind of be as crazy in your guess as possible. The IRS generally kind of has figured out that kind of numbers that are generally made up. Okay, so make sure you are actually doing the work. You're keeping a contemporaneous mileage log. A lot of times it can be done very simply using an app on your phone. Next, home office deduction. So this a few years ago became a situation. If you have a business now, if you're a corporation, a partnership, there is no home office deduction. So we're talking about an LLC or a sole proprietor on your individual tax return. You can take the home office deduction. And so this became streamlined a few years ago, $500, $750 up to $1,500, basically no questions asked outside of what was the area that was used for business and essentially kind of a description of the room. So it's a 10 by 12 room. It had desks and chairs, whatnot in it. Okay. Office that's areas in your home that are that are used for multiple different things, not generally used as a home office deduction. It needs to be an area used exclusively for as your home office. And then it can be a portion of a room, whatever the case may be. And you can use percentage method. So if you have a 1,200 square foot house and you have a 10 by 12 room, 10%, and then you can use 10% of your mortgage interest and other expenses. Never, ever, ever depreciate your primary residence. Okay, with rare exception. I should say never, ever, ever. With rare, I mean extremely rare exception, never depreciate your home. But your other cost, utility cost, etc., that percentage. But just remember, once again, you need to have contemporaneous records. So make sure that you have documented, you have pictures, things of that nature that can prove that that particular room is business use only and the size of the room, etc. Okay, and you will need to keep all of your supporting documents that relate to utility bills and etc. Okay. Next, contribute the maximum amount to your SEP or your solo K. If you have a team, I do here, we offer a 401k. Those are a little bit more expensive, and generally you can't contribute as much using that. But if you're a smaller business, just you as an employee, maybe you and a spouse, or you and a spouse and children, a solo K, a SEP may make a lot of sense. A simplified employee pension, that's what a SEP is, up to 25% of your net income. If you have a solo K, okay, it can be even more powerful at that point. You can put up to the $22,500 in 2023 into your solo K, $30,000 if you're over 50, and then you can put up to 25% in the profit sharing. Okay, but this does have to be done carefully. But you can do up to $66,000 or $73,500 if over 50 into your solo K. Okay, once again, you need to lean into your tax advisor, make sure this is structured correctly. You can do some cool things and do a rollover as a Roth, do a Roth conversion as well if you don't need the immediate tax deduction. And so there are some pretty powerful things you can do there. But once again, if you're going to do this, make sure you lean into your tax advisor so it's done correctly. Cost segregation, I'll talk about this a little bit more when I get into the real estate section here in just a little bit. Doing cost segregation on properties. If you're purchasing a property, cost segregation may make some sense. I'll do a little bit of a deeper dive of that in here in just a moment. Next, consider operating as an S corporation for tax purposes to save on self-employment taxes. Now, it's a little bit too late to do this for 23, unless it's a brand new business startup or you've just set it up here, in the last recent few months. If you've done that, consider maybe making an S corp election. Then you would have a salary for you personally, and then you could save on self-employment taxes on the difference between your salary and then the rest of the net income of the business. If you're married with no employees, you can hire your spouse. And install a Section 105 medical plan. I've talked about this in prior tax planning videos, but you can go through and actually have medical expenses become a direct write-off. Once again, there's a plan that has to be put in place. It is a little bit complicated. Make sure that you're leaning into your tax advisor. If a situation where you have employees, it's probably going to be a situation where it's not going to make any sense to do it. Okay, but if it's a kind of a smaller business, a situation to where you may be able to set up a Section 105 medical plan and set up this plan. This can and primarily in the biggest area where this is the easiest is within a C Corp structure. If your state has a 529 program, most states have either a deduction and some states even have a tax credit for 529 contributions. So you can go through if you have children, be able to contribute money into a 529 plan. This does not do anything for your federal income tax, but for your state, it may be a situation where you can put money in and get a tax deduction for a portion on your state tax return, or even a tax credit on your state tax return, and something, and then you can start putting funds away for your children's education. It can be used for elementary, junior high, high school, or for college. Next, a health savings account. And once again, on that point, make sure you understand what your state rules are. This isn't categoric. Different states have different rules. So make sure that you know what your state's rules are, or talk to your tax advisor, find out what your state rules are, and then go through and set up that 529 plan. Health savings account, this is one of those deductions there isn't an income limit on. So there are, for example, a traditional IRA. Okay, you can't take a tax deduction if you make over a certain amount. Okay, so with the health savings account, there's not a tax, a dollar amount that you can make to where you begin with the phase down with the HSA deduction. So, and you can contribute up to $3,850 for yourself, $7,750 if it's a family. You can go through and set up a self-directed HSA. Something else that's kind of neat to do is you can go through and, as you would with a regular self-directed retirement account, and go through and invest this in kind of non-traditional ways, meaning, not in the stock market or sitting in a money market account. Okay, another real cool thing you can do with an HSA is not reimburse yourself. Most people, they go through, they put the money in the HSA, they take the tax deduction, then they spend it right away. One thing that's really cool that you can do is not reimburse yourself, but keep the receipts and allow for that account to build up. And then some point down the road, maybe you get to the point of retirement, you've kept all your receipts from all the years in the past, and at that point you can reimburse yourself tax-free. So you can allow for the account to really get large and then reimburse yourself at some point in the future tax-free. Defined benefit plans or cash balance plans. This is a very complex area, but it's an area where you can put up between $250,000 and $300,000. I think it's $265,000 in 2023 into a retirement plan. Once again, this is complicated, it's expensive, but if you're in a situation to where your business makes a lot of money, okay, it could be a situation to where something you may want to look into. We have had clients who've gotten into this and didn't like the ongoing cost of it and the restrictions on it, and wanted to try to unwind it. Make sure you really understand what's going on if you're going to go down this road, understand what the costs are, but it is a way you can go about really having a very large tax deduction and also save for retirement as well. C Corps, one area that at least for 23, 24 is going to be something you may want to consider. We don't know what's going to happen once we get past 25 as it relates to the C Corp rate. Right now, that rate is 21%. The highest ordinary income tax rate is 37%. So it may be a situation, especially if you're maybe in active real estate, wholesaling, flipping, etc., that you may want to consider maybe doing this in a C Corp. Okay, now understand, if you're in a business to where you need to live off the money beyond your payroll, this may not be a situation to where it would make sense because you have a double taxation element. But if the money is staying in the business for the most part, with the exception of your payroll, and it may be a situation to where you may want to consider using a C Corp, using some of these other strategies in place, such as the Section 105 medical plan, or doing something else to be able to drive down that net income. And so, but consider, it may be a situation to where you may want to consider using a C Corp. Once again, there's more compliance requirements. It is a situation to where there's more that you're going to have to do. It's not as easy as running an LLC. Okay, so kind of understand that there's a lot more that's going on there. Usually when we had the conversation about C Corps, a lot of people ask questions about ROBs, which is a rollover as a business startup. Something you can do for your retirement, have an active type of a business inside of your retirement plan. Okay, once again, rules are a bit complex. So you do have to pay yourself a salary. It does need to be an active business. You can't have common employees within your control group. So there are a litany of rules that do need to be followed. So if this is a direction you're wanting to go, once again, make sure you're talking to your tax advisor and see whether or not that this makes sense. When we talk about loss harvesting or harvesting of losses, if you have large capital gains, if you have other areas, maybe it's stock, maybe it's crypto, other areas that you have large losses, you may want to go ahead and sell those particular holdings before the end of the year to be able to offset those losses against your gains. Because otherwise, if you have a very large gain this year, and then you decide in 2024 to go through and sell off a bunch of your losers, your losses are going to be capped at $3,000. Okay, above any sort of capital gains. But if you have a large capital gain amount, it may make sense that you have this crypto, it's lost a bunch of money, you don't want to be in it anymore, just sell it off, take those losses, offset it against your gains. Some points on real estate when it comes to short-term rentals. So if you have short-term rentals, your average daily rent is under 7 days. It is taxed like a hotel is taxed. Okay, it is taxed as active income, which means that you can offset any losses against active income. So say, your W-2, if you have a vacation rental and the average rental period is under 7 days. So you're in an area to where, your average person that comes in is just renting it for, 3 to 6 days. And you're going through, then you can go through and use some accelerated depreciation rules. You don't have to be a real estate professional to do this, okay? But you can then be able to take those losses and offset it against your W-2 income. And but if it's over that 7 days, it's gonna fall under the passive rules. And then at that point, you may not be able to take any losses, or up to only $25,000 of those losses in a given year. Still not a bad strategy to utilize, especially if you're in a situation to where you can expense up to write off up to $25,000 of those losses. It can provide you a little bit of tax savings. So understand the difference between short-term and long-term rentals. These rules have changed a little bit over the last few years. It was 30 days, now it's down to 7 days. I mentioned this earlier, the 80% bonus depreciation. So if you're going through and you want to utilize a cost segregation report on a rental property, or it may be a multifamily, whatever the case may be, understand that those categories, what normally was the 15-year, 7-year, and 5-year areas for depreciation that were 100% in 2022 are now at 80% in 2023. And you're not going to be able to utilize Section 179 for the 15-year depreciation, which essentially is the land improvement area of the cost segregation report. Still extremely powerful in 23. 24 it goes down to 60%, and then 40% in 2025, and then it goes away altogether. So it's still a good year in 2023. If you bought rentals, go ahead and utilize, and you're a real estate professional, you have material participation to be able to expense that depreciation and create a net operating loss essentially on your tax return if you have enough of them. And we have had some clients utilize these strategies. Just make sure you understand that if you do utilize this strategy, you may still have alternative minimum tax exposure. Understanding your taxes get computed in two different ways. Kind of the ordinary way, and then also an alternative minimum tax. So it takes away some of those tax favored items to determine if you still do owe tax, and you would still have self-employment tax and other types of taxes as well, besides ordinary income tax, even if you generated a net operating loss utilizing this strategy. Real estate professional status, this is an area to where the IRS does look at this. So 750-hour rule for a real estate professional. It does need to be documented, okay? So 750 hours documented, and then over half of your working time must have been spent doing this. And then generally it's it's going to be over half of your income as well is going to be coming from this area. Doesn't necessarily have to be, but the two areas that are solid and firm, 750 documented hours, over half of your working time. For material participation, meaning you're working on your own personal rentals and you want to be able to take the loss as 500 hours. And so that does need to be actually you working on the property. Continuing on in regards to rental properties, a point in regards to the types of business entity structures that you don't want to put rental properties in. C Corps or S Corps, if you or inside of your ROBs, unless you essentially are planning on only holding it for a short period of time and then flipping the property. Okay, so you never, ever, with rare exception, put rental properties into an entity taxed as an S Corp, a C Corp, or into your, of course, a ROBs is going to be inside of a C Corp. Now, the last items that relates to for 2023. Solar and other investment tax credits. This is one area where we've had a number of clients get into them. If you're going to utilize, and under the Inflation Reduction Act, there's some nice tax credits and whatnot that are out there. Solar is one big area we have clients getting into. If you're getting into this, make sure if you're only going to be able to utilize that depreciation if you have passive income and to be able to reduce your tax exposure. Okay, so if you have active income and you're getting into solar, you have to have material participation as it relates to into that solar investment. Most people don't. Okay, now there is a publication out there that kind of gets into all these different areas that the IRS looks at. They have 7 tests that they look at on whether or not it's considered active participation or material participation inside of the within the solar. Most people aren't going to meet that. Okay, so if you're going to utilize solar, use the depreciation, use the credits, you need to have other passive income. Otherwise, the solar investment may not make any sense. Okay, it can have a fairly decent ROI, but you may want to look into a different investment strategy. The tax credits for solar and these other investments, they are generally not refundable, meaning that you're not going to get the credit beyond your tax exposure, but the credits can be carried forward. Form 8300. If you end up receiving over $10,000 in cash from an individual or a business during the course of the year, this form does need to be filed. So I just want to kind of put that out there. Cash isn't something that's used less and less, but it is something I want to bring some awareness to. It's not necessarily a tax strategy or for tax planning, just a compliance piece. So if you have somebody who's paying you cash or whatever the case may be, that form does need to be filed and sent in. One big question as we look forward to 2024 that's being asked is in regards to this BOI form, okay, or the beneficial ownership form. This beneficial ownership report that does need to be filed with the FinCEN, with the Financial Crimes Enforcement Unit, with the Department of Treasury. Okay, so if you have a business, a corporation, an LLC, a partnership, and you're an owner, you, in all probability, are going to have this filing requirement. It's going to be disclosure of who owns the business. It's going to ask for driver's license information, a lot of personal information. And so this is under the Corporate Transparency Act that was passed, I think, in 2001. So it's basically, even if it's a trust, whatever the case may be, it's not going to get you around having to file this report. So with rare exception, unless you have a nonprofit or something to that effect, or a very large, corporate business where you may not have to do it, for most of you that are listening to this, if you own a business, you're going to have to file this particular report. So we'll be reaching out for our clients. So this next year you have, during the course of the year, it does need to be filed. If it's a new business startup, it's 30 days. I think now it's been extended to 90 days that you have after the business is set up to file this particular report. It is definite government overreach. Okay. However, a situation where the fines are hefty, unless your last name is Biden, the fines are hefty. So just make sure that you're going through and this particular report is filed. We'll be reaching out to our clients this coming year and making sure that they're all compliant. So make sure you're reaching out to your tax professional or your attorney to make sure that this report is filed. Thank you for taking a few minutes to listen in. Hopefully you were able to take an item or two to be able to put into use. If you are a client, this particular podcast will come with a link to schedule a year-end meeting with my team. If you're not a client, hopefully you learned an item or two, maybe something you can take back to your tax professional, something you can implement inside of your business to be able to save yourself a few dollars on your tax bill. Have a wonderful day.